Johan, good morning. Devi joining this conversation. But what about the great policy divergence that we've been talking about? And as an investor, how are you thinking about advising clients on that front? Because we just heard from China again, injecting more liquidity and trying to be in easing mode at a time when the Fed is continuing to signal perhaps that they could go faster than expected. They haven't signaled that as yet, but getting there. What do you do in that sort of an environment?
Well, I think, it's not always the case that all policies and all economies run in complete sync. So divergence is something that we deal with from time to time, and it's been the case for a while now. I think that the Chinese economy does look like it needs a bit of stimulus. I think that it has in front of it a major deleveraging cycle triggered by what's going on in the property sector. You've seen the Evergrande situation, and it's spiraling into other bits, and that means deleveraging, as we saw post Lehman in the West, is definitely a deflationary force, and it pulls back economic growth. So therefore, some degree of stimulus might be necessary. So from that point of view, entirely reasonable to talk about policy divergence. Fed has to be on the move because it's not faced with a serious Omicron wave. In the sense that it's going to really tank economic growth much more than a blip in Q1. And it's got an inflation issue, so the Fed has very little choice but to get on the brakes. And that's why we have what we have. So you are going to see differences in interest rates. You're going to see differences possibly in stock market reaction. And this is how you have to position yourself Q1, Q2, maybe the whole of the year.
Right. My bigger worry is if inflation eats into growth in the U.S. and then back to Asia, China is struggling with its own consumption challenges because of its zero COVID policy. That's the two top growth engines of the world. And so what does that do for global growth and just, the hunt for yield in 2022?
I don't know if we should be too despondent about global growth past of Q1. We've made this mistake before of essentially getting maybe a little bit complacent about where COVID goes. But let's assume for a second the current wave is as bad as it gets. Then Q2 and 3 in the US is not going to be anything looking like too much of a contraction. On the contrary. So I think we can be relatively secure in the knowledge that US growth is okay, even if the Fed has to move by 25 basis points several times this year. I think that the growth cycle there is in reasonable shape and moderate inflation somewhat. And keep in mind, Chinese numbers 4.9 for Q1, or where we were last numbers released, it wouldn't be Q1, it would be Q4 last year. Maybe under pressure for a quarter or two, but these are not catastrophically poor numbers. I think keep in mind that there is still a strong growth cycle. We just need some moderation on the inflation side in the US, and the Chinese economy will get through what it is going through at the moment. And we can look forward to reasonable growth for the rest of the year. A bit of headwinds coming up at the moment, Q1, possibly Q2.